NASDAQ has rolled a little bit as well, which is right now down about 2/3 of 1%. But Belsky, I'm going to go to you because the NASDAQ is part of your story here.
It is.
You've seen the move in tech, which you've upgraded as well, but now your price target goes to 45.50. It's the second highest on the street, only to Sam Stovall, who was 45.75. Obviously, you figured I would give you the business too much if you went to the highest, so you had to go just under that.
That's exactly why.
I'm inside your head, dude. So what's up with this, really?
So thanks for having us. We, across the board with all three of our scenarios, increased our price targets by 250 points. We just thought that was apropos, especially given where we thought the worst case scenario did not occur this year. That's kind of number one. Number two, from a fundamental perspective, when you decrease the cost of capital and you decrease our equity risk premium and you decrease kind of what's happening in inflation, that helped us equate to our dividend discount model to pump out a bigger number.
So there's an expectation that in the second half of 2023, that inflation is going to continue its downward trajectory and that the Fed is no longer going to have to raise interest rates because financial conditions in the United States are tightening on its own. So what I kind of see going on is a bifurcation of the U.S. economy. The high interest rates are causing many sectors of the economy to slow down, while the gains with technology are going to cause certain areas of the economy to accelerate. And it's fascinating to see how these play together because it could end up doing the job that the Fed was trying to do, right? So one of the things that we have to pay attention to is interest rates and how that's affecting consumer spending. So credit card interest rates are extremely high. Rates for auto loans are extremely high. Mortgage rates are extremely high. And with the housing sector, it's very interesting because there are pockets of real estate that are seeing declines in home values, but there's also others that are holding up and people are still demanding very high premiums for their property. For example, in the area where I'm at, and they don't care what the interest rate is. They're going to ask for what they're asking for, right? So a lot going on here, but diving into the artificial intelligence, I will talk about that a little bit more in this video. But let's get into this segment with CNBC and what they see and why they're raising their price targets for the S&P.
Now, the first thing you're going to say is Belsky 20 times, right? You're going to say that. And my retort would be, coming out of bear markets traditionally, and we wrote about this in our year ahead piece, that you see 6 multiple points increase from the bottom. We're about halfway there. So we still think there's still multiple expansion. I would like to note, though, this is the very first time that we're overweight technology since 2019. And that's kind of a big call for us. And so we're getting a lot of feedback, let's say, that we're late on tech. I don't think we're late on tech. I think this is just beginning. And so we really think that the secular bull is still very much alive, our 25-year call. We think the market bottom in October, and we think that there's more upside.
So when they're discussing the recovery in the stock market, they're actually looking at the technology sector. So with the recent announcements from NVIDIA, also with ChatGPT and other artificial intelligence products coming to market, along with products that are already existing in the marketplace for automation, they're seeing a turnaround in the market and predicting that once these technologies get fully in place and start to get consumed by corporations, that will lead to a lot of growth in these companies, right? So as I talked about this earlier, right, there's this big wave that's on the way that people don't understand what exactly is coming. And I don't think that many people are actually prepared for it, right? These companies that own these products like Microsoft, generative AI, they're already going and doing pitches at corporations and explaining to them how this new technology can lead to huge growth for them by basically automating a lot of the processes that they have, right? And also showing that they'll require less people. And they're going over use cases and explaining how this technology could be leveraged to do various things within their company. So when you look at what's going on with NVIDIA, I don't know about that one because it's not so much about the hardware as it is about the software, right? And now that you have cloud service providers like AWS, Google Cloud, you have Microsoft Azure, they already kind of have built into their data center the capabilities to run these type of products, right? So I'm not so keen on looking at the hardware aspect of it. But what I am looking at is that if they implement these technologies to start taking over use cases within a business, meaning, the transactional work, the process work, interactional work, even design work, data analytical work, they're going to need a lot less people because the technology is going to be able to do it more efficiently and a lot faster, right? And so if you look at what is one of the biggest costs for corporations, it's the cost of human labor. Recently, in the ports of Long Beach and Los Angeles, the longshoremen went on strike because they want to make more money. Hey, I understand, and if you can get it, you can get it. But at the same time, you have to look, there's already a port in China that's fully automated, right? They have way less people. They have, less risk of accidents happening or less of a risk of loss of human life because there's no people around. It's all automated with robots and artificial intelligence managing the port, and you have a few people that are managing the robots and the AI, to run the port. So what's to stop that from happening here? You have human capital labor that's increasing in cost. As a business, you're looking at that cost, right? And so if it gets to a point to where it becomes very problematic, then it may be worth it for you as a business to make that capital investment into implementing these solutions that you can depreciate and save money over time, right? And operate more efficiently because robots and artificial intelligence don't need breaks, don't need sick days, don't need vacation, don't need social security, don't need retirement. They don't need any of that, right? And so that's something that can be universally applied across the entire corporate sector of America. And so what that means is that there's going to be a lot less people required to do these jobs. So when you look at what the Fed is trying to accomplish with bringing down inflation, it may happen naturally, right? The situation that's happening in the banking sector with commercial real estate, that's already causing tightening in the lending sector. I read an article recently where there's a company trying to do a project where they reached out to 48 lenders and cannot get financing to do the project, right? High interest rates is also slowing down the housing market. It doesn't mean that the market is going to crash. Of course, there's areas where prices are going to come down, but there's also areas that are very desirable and the prices will stay strong. And the people who have these properties don't care what the interest rates are. Then you compound that with people that are in fixed rate loans that are extremely low interest rates. There's no incentive to move. It'd be financial suicide for you to move out a mortgage that's less than 3% to take one that's over 7%, right? So you have a huge log jam there. So that's going to cause a slowdown in housing. They pulled forward so much price appreciation that for the next probably 5 to 10 years, we're not going to really see a lot of home price appreciation because the wages don't support it, right? And going back to artificial intelligence, as corporations start to take on those technologies and implement them, you will slowly see employees being let go. They'll start off by telling you they're going to put you in different jobs and have you do higher value work. But in actuality, they don't need you anymore. And so they're going to reduce that load. And what that means is that earnings for a lot of corporations is going to improve, right? Remember earlier I was saying, if you don't know what your resource model is going to look like over the next 24 months, does it make any sense to bring anyone back to the office? It's easier to let people go when they're working from home than they are when they're working in the office. And so now that these companies are going and pitching to corporations on how artificial intelligence, machine learning, and automation can basically lighten their load, they're listening, right? And so if they make the decision to go down this path, they're going to continue to let people work from home until they get these solutions implemented. But slowly you're going to see that the workforce is going to shrink and that unemployment is going to go up. And the Fed is not going to have to do anything, right? But sit back and watch it happen. And then if it gets too much, then maybe they'll stop dropping interest rates. So what you're seeing is a lot of financial analysts are raising their price targets because the market is forward looking. They're saying, okay, we got this new technology. Okay, what does it really mean, right? Oh, businesses are going to be able to get rid of people. They're going to be able to automate a lot of processes. Okay, well, we know that the human labor component is one of the biggest expenses for corporations. So how is that going to affect the bottom line of these businesses? it's going to be extremely helpful. It's going to make them look more profitable. And that means that stocks are going to go up. So I believe that that is what you're seeing, is that the market is recognizing the great transition that's coming as we enter into this period that I refer to as hyper transformation, right? But let's hear more.
Now, it's not an exciting number. We're talking 6% upside. But
Well, I mean, after what we've already had, it's kind of exciting to think that, where we came into this year, with many assuming that it was going to be a tough year, at least for the good part of it, for all the obvious reasons, the economy slowing down, the Fed's still highly engaged. I think a lot of people would take 45.50.
Yeah, I think very much so. And again, I hope I'm wrong. I mean, our bull case scenario is 50-50, meaning 5,050, and that would be an all-time high on the S&P 500. I think we really need to see earnings get cranked up. And as we said in our note, obviously the institutional investors we speak with and the market itself is really positioning for 2024 earnings. And this 220 number that our number is for 2023 looks like a pretty good number. It could be a little bit higher, but we need to see significant contribution from tech the second half of the year to make that number a lot higher.
So you clearly were moved by the strength in tech, unforeseen by you and many others, obviously, from the beginning of the year, enough so that that's enough of a driver. And by the way, you're not the only one who thinks there's potential further upside to the S&P and earnings as a result of what's happening with AI. David Kostin at Goldman Sachs says further upside to S&P is possible if investors see profit and productivity from AI, which they obviously do.
I think one of the biggest misses that people aren't talking about is coming into this year, Scott, next 12-month earnings for tech were actually modeled for below the market, okay, below S&P 500 earnings. And what we've seen over the last 4 or 5 months now, tech is beginning to surpass on an earnings growth rate. So revisions clearly, meaning earnings revisions on a fiscal year basis, clearly bottomed out. Now they're beginning to recover. So we're starting to see the semblance of not only earnings stability there, which has been our call all the time with tech, but earnings acceleration, and I think that's what's really going to guide it.
I think
so. The translation is that a lot of corporations across America are buying this technology, and so that's why they're seeing this growth in tech. A lot of corporations are signing up to take on this technology because they see the potential, right? Like I said, corporations are focused on their bottom line. It's not about what's the socially right thing to do, right? That's the illusion or the delusion that they want you to have, right? At the end of the day, it's about how can they increase value and make profit for their shareholders. And so when you have a value proposition that can potentially boost profits while at the same time reduce your operational expenses, that's a very, very strong argument and very hard to ignore. So a lot of corporations across the United States are signing up and buying licensing agreements for products like ChatGPT. Companies like Microsoft are going to continue and go across the world, and they're going to pitch and market these products to corporations everywhere and show them that, hey, this is the potential. This is how you can use this product. This is how you can simplify and automate things, right? Looking at this stuff, man, I've actually seen it. It's actually pretty astonishing what it can do, right? It's going to become a requirements game, right? If you can build strong and solid requirements, you can have AI do all sorts of things that eliminate the need to have a human there, right? So, and then there's the data science part of it, right? So, looking at what's going on, I'm seeing the writing on the wall. We're seeing the increase in these technology companies that are pushing these products. And so corporations across the United States, they're buying it, they're going to implement it, and we'll see how it unfolds, right? They're saying that they got to see the change in earnings, but the expectation is not to really see anything until 2024. It takes a while to implement these things, right? It goes in phases. So first comes the sales pitch and trying to explain to businesses how the product can add value to them. Then there's the negotiation of, buying licensing for the product. Once you purchase the product, then you have to work internally with your architects to develop your use cases and how the product's going to be implemented. Where are you going to use it in your business? Putting your projects together and funding them so that the solutions can be put in place. Getting the people that are doing the job currently to explain how they're doing their job, documenting their processes and making sure they got clear documentation. then that gets fed to the AI, which will then replace the person, and then the person gets let go. That's pretty much how the cycle works. And as those people get let go, they don't get replaced, and that's going to impact the bottom line of the corporation, right? Same thing with, moving technology from being inside your house to being outside your house and having someone else take care of it, right? It becomes less expensive. So this is what they're referring to where they're talking about how we're seeing, the responsiveness in tech stocks and, but at the same time, they want to look at earnings to see how well corporations are doing as they implement this technology. Are they able to realize the gains that are being proposed by these products? So let's continue.
What's clear is that this AI revolution has blindsided the market, blindsided investors, blindsided some companies that were in the space that got blindsided by who was going to take the alleged lead in the arms race that we're witnessing. And now we're trying to play catch up in some sense.
I think very few had factored in the contribution to earnings that generative AI was going to realize. And it's a reality that's here, it's now, it's present. We saw it in NVIDIA's earnings. I think it's concurrent with positioning, which coming into the year was massively underweight technology to a level and an extreme that we have not seen since the great financial crisis. But ultimately, I think it comes back to leadership. And I think for the very first time since 2019, we've identified the potential leadership for more than a moment. If you go back and you reflect through 2020, we've had these periods of fits and starts. It was the work from home leadership. It transitioned to the vaccine and the reopening and the roaring 20s trade and the cyclical trade, but you could never establish consistent leadership over a significant period of time. And I think, Scott, you have the potential for that now, and that would lead you to doing what? Erasing the you from the conversation of the earnings recession and having the expectation be it's a
right.
V.
And I think the most confounding thing for most investors, Scott, has been there've been three tech rallies this year, right? You had the January effect rally in January, where the majority of leadership came from the worst performers in 2022. Then you had the rotation out of financials into tech. Then you had the AI boom, right? So I think a lot of investors on the first two missed it because they didn't believe it. Now they're all of a sudden believing it because the fundamentals and the earnings are starting to come through. And that's why I think the move is real.
So now's the time to really pay attention to what's going on, where you get your bag from, because there is a lot of distractions going on right now that are designed to get to you emotionally and cause you to not pay attention, right? So if you look at certain hot button issues that are going on right now, they're trying to get people very emotional, and I think they are important issues, right? When it comes to parents' rights over how they raise their children, you'll see that the way that the system is evolving, the government is slowly but surely giving more power to the school systems to have greater control over your children, which to me is very dangerous because ultimately parents are accountable for their children. But it seems as if the school system is being put more in charge of your kids and educating and involving your kids than you, the parent, does, right? So that's something that I think is important that we got to pay attention to. I do believe that parents have the ultimate authority and should be the ones that have control over how their children are raised. I am aware that there are plenty of village idiots out there that don't know how to raise children, and that's another topic, right? But what's really, really important is to pay attention to how the economy is getting ready to change, and it's going to change in a major way, and people are just not prepared for it. I can't say it enough, right? So, you got autonomy coming, right? And that's going to have a huge impact, and those use cases are huge, right? There's many different sectors that are going to get impacted by it, right? Then you have, automation and artificial intelligence. I know I'm beating a dead horse when I talk about it, but it's very, very important to pay attention to what's going on in the places where you work to see how these technologies are being brought in and what is the plan to implement them and what are the implications to you as the employee of said company that's implementing those technologies. Does it mean that you need to start looking for something different to do? Are there certain skill sets that you're going to need to continue to be valuable to the economy so that you keep your job? Or does it mean that you have to go on your own and figure out a different path forward, right? Because what you're doing today may not exist tomorrow in the way that you see it today. And so you're going to have to think outside of the box and figure out, how are you going to go forward in this economy and basically sustain yourself, right? So what's your path forward? So with that being said, I know it's been a long time since I posted a video, took a vacation. I needed some time to kind of just do a lot of research and look at what's going on in the environment, to really think about what it is that I wanted to talk about. But I think that this topic is really, really, really important and that people need to pay attention to it. Of course, there's other things that are going on in the economy. I don't think that the issue with the regional banks is over, that's going to continue. They're looking at how to cut their loan books and cut their risk. But make no mistake, there's going to be a lot of scenarios where properties are not going to be able to be refinanced, which means that they might come back into the possession of banks, which means they'll have to put those properties up for auction so that they go at market price. Maybe they'll come up with some type of plan to keep them on their books, but it is going to be a hit, right? And so these things play with each other when it comes to bringing down inflation, right? And so we'll see what happens. So with that being said, if you like the content, please give me a like and subscribe, and I'll see you on the next video.